Picture this carefully. You wake up and your bank account shows zero, every dollar gone. You call the bank in panic. An hour later, they calmly tell you not to worry. The money was not stolen. It was temporarily reallocated to reassure another client that the bank had sufficient reserves. They promise it will be returned before you need it. No harm done, they say. Just a short-term accounting adjustment. Would you accept that explanation? Of course not. Because money that is yours cannot be borrowed without permission just to make a balance sheet look healthier. Intent to return it later does not erase the violation. It does not erase ownership. Now replace your bank account with 100,000 ounces of silver sitting inside a COMEX vault. Replace the temporary reallocation with a futures contract sold by a major bank. And replace the polite bank manager with financial media repeating that inventory levels are strong and there is no shortage. Today is Tuesday, February 17th, 2026. And what is unfolding inside the silver market is not volatility. It is not speculation. It is a structural stress event disguised as stability. The system appears calm on the surface because most people are only shown one number, total inventory, roughly 381 million ounces of silver inside COMEX vaults. That sounds enormous. It sounds like abundance. It sounds like anyone warning about shortage must be exaggerating. But that headline number hides a fatal distinction. There are two categories of silver inside the COMEX system, registered and eligible, and they are not interchangeable. Registered silver is the only metal that can legally satisfy a futures delivery demand. It carries a warrant. It is tagged, documented, and officially available to settle contracts. If a long holder stands for delivery, this is the pool the exchange can draw from. Nothing else counts. Eligible silver is different. It meets purity standards and sits inside approved vaults, but it belongs to private owners, family offices, sovereign funds, institutional holders. It is stored there for convenience and security. COMEX does not own it. The exchange cannot compel its sale. The shorts cannot borrow it. It is simply parked there. As of February 12th, total COMEX silver inventory sits around 381 million ounces. That is the number flashed across financial news. But when you break it down, registered silver, the only category that can actually be delivered, stands at approximately 98 million ounces. For the first time in years, it has fallen below the psychological 100 million ounce threshold. Eligible silver accounts for roughly 283 million ounces. That means nearly 74% of the reported inventory is not legally accessible for delivery. 3/4 of the supply cited in headlines cannot be used to settle contracts. Imagine a storage company renting warehouse units to hundreds of customers. Inside those units sit cars, furniture, equipment, property belonging to tenants. Now imagine the storage company going to a lender and claiming all those items as assets backing a loan. It would be fraud. They provide space, not ownership. COMEX vault operators are storage providers. The eligible category belongs to clients. Yet the paper market behaves as though the entire vault is collateral for short positions. This is the illusion. And it works because most people never separate the two categories. Now consider what is happening beneath the surface. In early January, registered inventory stood near 110 million ounces. A few days before February 12th, it was around 101 million. As of February 12th, it dropped to 98 million. That is a 12 million ounce decline in just over a month. But the pace is accelerating. On February 11th alone, approximately 3 million ounces shifted from registered into eligible status, and another 4.7 million ounces withdrew entirely from the eligible category. Nearly 8 million ounces moved in a single session. Metal is leaving the system faster than it is entering. This matters because March is a major delivery month, and first notice day is February 27th, 2026. Based on current open interest trajectories, projections suggest that between 120 and 130 million ounces could potentially stand for delivery in March, against registered inventory that is already below 100 million ounces and trending downward. Even at 98 million ounces, that implies a 20 to 30 million ounce deficit for March alone. If registered falls towards 70 or 80 million ounces by first notice day, which current trends suggest is possible, the deficit widens to 40 to 60 million ounces. That is not marginal imbalance. That is systemic shortfall. The entire structure depends on the assumption that most contract holders will close positions for cash before demanding physical metal. Historically, that has been true. The vast majority of futures traders are speculators. They do not want bars delivered. They want price exposure. But this cycle shows unusual persistence in open interest. Instead of collapsing sharply as deadlines approach, it remains elevated. That suggests some holders may intend to stand, and if they do, the math becomes unavoidable. Some argue that eligible silver can be converted into registered status if necessary. Technically, yes, but conversion is voluntary. The owner must agree to reclassify the metal and attach a warrant. COMEX cannot compel that action. Why would a private owner surrender control of their metal during a tightening supply environment? Why would a sovereign fund convert eligible holdings just so banks can settle short positions at suppressed prices? They wouldn't, unless incentivized with higher prices, which is precisely the problem. The banks have sold more delivery obligations than they have registered metal. They are operating on a fractional reserve basis. As long as delivery demands remain low, this structure survives. But if a larger than normal percentage of longs stand, the banks must source metal externally or negotiate conversion at premium prices. There is no legal escape hatch called "we oversold." Force majeure does not apply because inventory was mismanaged. Contract law excuses performance only when extraordinary, unforeseeable events make delivery impossible: natural disasters, war-destroying infrastructure, government export bans. Running out of metal because leverage was excessive is not extraordinary. It is a failed risk calculation. If delivery demands exceed registered inventory, the banks must either buy metal in the open market or pay whatever premium eligible holders demand for conversion. An open market buying of tens of millions of ounces in a tightening physical environment does not produce gentle price appreciation, it produces repricing. Now layer in what is happening globally. Shanghai closed for the Lunar New Year at $86.91 per ounce. COMEX spot around that time sat near $76.71, a 10-20 gap. That difference is not random noise. It reflects willingness by Chinese buyers to pay a premium for assured physical supply. Industrial users cannot gamble on paper. Factories require certainty. Production lines depend on metal. That 86.91 becomes a benchmark. When Shanghai reopens, that level represents recent replacement cost in the world's largest industrial consumer market. If Western paper prices are pushed significantly below that during the holiday, arbitrage pressure builds. Buyers see discount relative to physical benchmark. They step in. The paper price can be nudged lower temporarily, especially during thin holiday trading. But sustained suppression below physical replacement cost becomes increasingly unstable. So here we stand on February 17, 2026. Registered inventory shrinking. March delivery approaching in 10 days. Open interest elevated. Shanghai benchmark established at $86.91. And a paper system dependent on most participants never asking for what they were promised. This is not just another price cycle. This is a countdown. Now let's push this further because the pressure is not isolated to one exchange or one city. It is systemic. And when systems begin to strain, the cracks appear first at the edges. Shanghai's close at $86.91 before the Lunar New Year was not just a higher regional price. It was a declaration from the physical market. It said, this is what guaranteed silver costs, not paper exposure, not a futures promise. Actual deliverable metal. The COMEX spot price around $76.71 at that same time reflected something different. It reflected leverage positioning, short-term speculation, and the assumption that delivery demands will remain manageable. That 10-20 spread is the difference between certainty and probability. Imagine you operate a solar panel factory in Guangdong province. You have contracts due in March. You need 20,000 ounces of silver to fulfill production schedules. You can either lock in COMEX futures at $76 and hope delivery works smoothly in 3 months, or you can secure metal in Shanghai at $86.91 with near-term assurance. Which do you choose? If production delays cost millions in penalties and lost contracts, a $10 premium is insignificant. You choose certainty. You choose the metal that shows up. That is why the Shanghai price matters. It is not speculative enthusiasm. It is industrial necessity. It is replacement cost. It reflects what buyers are actually willing to pay when operations depend on supply. Now consider what happens if Western banks attempt to force the paper price down while Shanghai is closed. Thin liquidity during the holiday creates opportunity for aggressive selling. If COMEX is smashed to $65 or $60, the spread between New York and Shanghai widens dramatically. When Shanghai reopens, traders immediately see the gap. The instinct is to buy where it is cheap and sell where it is expensive. But here's the complication. Physical silver is not infinitely mobile. Vault inventories are already tight. Export channels are not frictionless. Arbitrage cannot instantly equalize pricing. If the paper price falls too far below physical benchmarks, buying pressure intensifies. Industrial users step in. Importers hedge forward purchases. Financial players recognize mispricing. The deeper the discount, the stronger the demand response. That is why 86.91 behaves like a floor, not because it is magical, but because it reflects real-world willingness to transact. A paper market cannot sustainably exist below physical replacement cost without creating instability, and instability is already visible elsewhere. Over the weekend in Shenzhen, the jewelry trading hub experienced something far more revealing than price volatility. Authorities intervened. A major trading platform offering prefixed pricing contracts failed to meet delivery obligations. Customers who had locked in prices with deposits showed up expecting metal. The supply was insufficient. Executives were detained. Operations were halted. The government banned prefixed pricing structures and shifted the market toward immediate cash and carry transactions. That shift tells you everything. When leverage collapses, authorities remove the leverage. When paper promises outstrip physical availability, regulators eliminate the promise mechanism. What remains is real-time settlement. Pay fully, take delivery immediately, liquidity evaporated. Dealers holding inventory became cautious, sellers hoarded. Buyers faced tighter supply. This is not a uniquely Chinese vulnerability. It is a universal structural issue. Paper contracts depend on confidence that delivery will not be demanded en masse. When that confidence cracks, the entire system must either reduce leverage or reprice dramatically. COMEX operates on the same foundational assumption that most futures contracts will never require physical settlement. Historically, that assumption is held, but as inventories drain and physical premiums rise, the risk profile changes. Let's refocus on March. First notice day, February 27, 2026. As that date approaches, open interest should normally collapse. Traders who never intend to take delivery exit positions. Speculators roll forward, the delivery month quiets down, but this cycle shows unusual resilience in open interest. That suggests at least some holders may intend to stand. If 120 to 130 million ounces are demanded and registered inventory has fallen towards 70 or 80 million ounces, the exchange faces a visible deficit. The banks can attempt to persuade eligible owners to convert metal into registered status, but eligible holders are not obligated to comply. Many of them may be long futures contracts themselves. They may be strategically accumulating. Why surrender metal during tightening supply conditions? If eligible holders refuse, the banks must source metal externally. And external sourcing of tens of millions of ounces is not trivial in a tightening market. It pushes price higher. Now consider the interaction between physical stress and geopolitical risk. The Strait of Hormuz remains a critical artery for global energy supply. Escalating rhetoric and military positioning increase the probability of disruption. Even temporary shipping instability can shock oil markets. Energy costs ripple through supply chains. Inflation expectations shift. Confidence in currencies depends on stability. Reserve status depends on credibility. If geopolitical escalation undermines confidence, capital rotates into tangible assets. Silver, positioned at the intersection of industrial necessity and monetary hedge, becomes particularly sensitive. If a delivery squeeze is building at the same time geopolitical stress rises, the repricing mechanism becomes nonlinear. It does not drift upward slowly. It accelerates. The banks understand this. They understand that their fractional reserve structure functions only as long as delivery demands remain moderate and price volatility manageable. That is why you may see aggressive price moves in thin trading conditions before February 27th. If price can be pushed down sharply, it may discourage some longs from standing. It may create the appearance of weakness. It may trigger stop losses. But if registered inventory continues to drain while price is pushed lower, that divergence signals stress rather than surplus. Watch that carefully. If price drops but metal leaves the vault, the supply is not increasing. It is tightening. We are in the final stretch before the delivery test. The next several days will reveal whether open interest collapses normally or remains elevated. They will reveal whether registered inventory stabilizes or continues to fall. They will reveal whether geopolitical headlines intensify. 3 variables converging. Inventory, open interest, geopolitics. This is not about daily noise. It is about structural alignment. If all 3 move in stress-inducing directions simultaneously, repricing becomes more probable. The silver market has operated for years on the assumption that leverage can be rolled indefinitely. That assumption now faces an expiration date. February 27th is not symbolic. It is contractual. It is when paper promises must either be rolled or converted into metal. If too many choose metal, the illusion dissolves. And once illusions dissolve in leveraged markets, price adjusts not gradually, but decisively. Now we come to the moment where the theory is forced into reality. February 27th, 2026, first notice day for the March silver contract. That is the date when the futures market stops being a game of price exposure and becomes a test of physical supply. On that day, long holders make a decision: sell the contract and take the cash, or hold through and demand delivery of real metal. Historically, almost everyone chooses cash. That behavior is what allows the system to function on leverage. It allows banks to sell far more delivery obligations than they have registered inventory because the overwhelming majority never request the bars. But this time, the math is uncomfortable. Registered inventory has already fallen below 100 million ounces and is trending downward. If the current drain continues, we could see 70 to 80 million ounces remaining in the registered category by the time first notice arrives. At the same time, open interest suggests that between 120 and 130 million ounces could potentially stand for delivery. Even at the conservative end, that leaves a 40 million ounce shortfall. At the upper end, 60 million ounces. You cannot deliver metal that is not registered, and registered is the only category that counts. The bank's first move would be to negotiate. They would approach eligible holders and attempt to persuade them to convert metal into registered status. They might offer premiums, they might offer incentives, they might structure private deals. But conversion is voluntary. Eligible owners are not obligated to rescue short sellers. Many eligible holders may be strategic buyers themselves. If they believe supply is tightening and prices poised to reprice higher, they have no incentive to surrender control at suppressed levels. If conversion fails to fill the gap, the banks have one remaining option: purchase metal in the open market. And open market purchases of tens of millions of ounces in a tightening physical environment do not happen quietly. They drive price. Price is the mechanism that balances shortage. When demand exceeds available supply, price rises until sellers emerge. The problem for the shorts is that the rise may not be incremental. It may gap. When markets realize that delivery obligations exceed registered inventory, confidence shifts rapidly. Confidence is everything in a leveraged system. As long as participants believe delivery will function smoothly, leverage can persist. Once doubt enters, behavior changes. Long holders who might have rolled positions begin to stand. Eligible owners who might have converted begin to refuse. Buyers who might have waited begin to accelerate purchases. That behavioral shift is what creates squeezes. Now layer in the geopolitical variable one more time. The Strait of Hormuz remains one of the most critical choke points in global trade. Any disruption, missile strike, naval incident, shipping blockade, would shock energy markets instantly. Oil prices would spike. Inflation expectations would surge. Currency confidence would wobble. In such an environment, capital seeks assets with no counterparty risk. Gold is the traditional refuge, but silver carries a dual role. It is monetary insurance and industrial necessity. That combination amplifies demand under stress. If geopolitical escalation intersects with a delivery imbalance at COMEX, the repricing would not be orderly. It would be abrupt. Now consider the positioning. If you hold only paper exposure and the exchange invokes cash settlement mechanisms during stress, you may receive the previous paper price while physical trades at a premium elsewhere. That is not equivalent exposure. Physical ownership removes counterparty dependency. Allocated segregated storage ensures specific bars are held on your behalf. Diversified storage locations reduce risk concentration. This is not about short-term trading strategy. It is about structural risk management. The cost of entering at $76 versus waiting for confirmation must be weighed against the potential cost of being absent if repricing occurs toward $120 or beyond. Volatility will be present. There may be sharp pullbacks, but volatility in tightening supply environments often reflects stress, not abundance. Watch the data. If registered inventory continues to decline daily while price attempts to fall, that divergence is telling you something. Supply is not increasing. It is leaving. If open interest remains elevated into first notice day rather than collapsing, that is another signal. If geopolitical headlines intensify, that adds pressure. We are within a narrowing window where leverage meets physical constraint. The eligible illusion has allowed the total inventory headline to mask deliverable scarcity. But eligible is not registered, and registered is what counts. Shanghai's 8691 close established a physical benchmark. Shenzhen's enforcement action exposed the fragility of leveraged prefixed contracts. March delivery looms as a test of whether paper obligations can be met with actual metal. The banks know the calendar. They know the inventory levels. They know the open interest figures. And they know that this week, while some global markets remain on holiday, offers a temporary opportunity to influence sentiment. Expect volatility. Expect attempts to shake confidence. Expect narratives emphasizing calm and dismissing shortage concerns. But focus on the underlying numbers. Inventory, open interest, delivery deadlines. Those are not opinions, they are measurable. If February 27th passes smoothly with open interest collapsing and inventory stabilizing, pressure resets. The system survives another cycle. If it does not, repricing accelerates. You are not watching a routine commodity fluctuation. You are watching a structural test of a fractional reserve metal system. The illusion remains intact only while delivery demands remain manageable. 10 days ago, registered was above 100 million ounces. Today, it sits below. 10 days from now, the system must reconcile paper with metal. Markets can ignore stress for a time. They cannot ignore settlement forever. And settlement is coming.